Let's get a look at what we should be watching as trading gets underway in Asia, such as it is on Chinese New Year. Bloomberg's global markets editor Adam Haig is here. Adam, one place we're seeing the strong yen become an issue is with Japanese investors fleeing from treasuries despite the extra yield they offer relative to bonds back at home. But here it's really about hedging costs trumping that attractive yield, right?
Yeah, Paul, and it's kind of one of these things where the strength of the yen is kind of throwing up problems for investors in different ways. And what we're seeing really is Japanese investors really coming out of their US bond exposure. Let's have a look at it on the chart. #BTV 1315. And part of this is around that strength in the yen that we've been seeing and the accompanying dollar weakness. And it's just pushed those hedging costs up to pretty much levels that we've not seen since the financial crisis. And it just makes that attractive yield that you get on Treasury is just that much harder to balance against those extra costs that you pay for it. So I think what people in Japanese investors are really waiting for is some indication from Jay Powell as to the trajectory now of Fed rate hikes. I mean, there's a debate going on, of course, as to the pace of that tightening in the US, and I think that if we do see the 10-year get across that 3% level, you'll start to see a few more of those Japanese investors coming back to want to own some more treasuries at that point. But it's it's a bit of a moot point because we have no indication really how Jay Powell's going to run things. The bond market is certainly readjusting, continuing to readjust closer to the Fed's stated dot plot for hikes in 2018 and 2019. So until we hear from Jay Powell later this month, it's really a tough place for Japanese investors.
Absolutely, Evan. That 2.9% barrier may be waiting for words from Jay Powell before it actually gets broken. Let's turn to our team in Tokyo, looking at why stock picking has become a dying art in Japan. Seems like investors might be looking more at Japan, not less, given all the improvement on the corporate side.
Yeah, well, that's what you would have thought, right, Kathleen? And, it's been an improving story under the Prime Minister over the last few years. And as this chart really quite clearly shows, the return on equity that you're getting, 9576 here, the return on equity has been an improving story. You've got improving corporate governance. You've got an update to the stewardship code that's coming this year. And increasingly over the last 24 months, we've heard from foreign investors who are, more attuned to some of these very nuanced changes that are happening in the corporate landscape in Japan. But what our folks did in Tokyo was spoke to an old sage in the market, a guy called Sean Taylor over at Deutsche Asset Management, and he's been looking at this over many, many years. And when he first joined Swiss banking operation 10 or so years ago, he said that there were so many analysts scouring Japanese companies, and now he just doesn't see that in his new role at Deutsche Asset Management. And he says there's lots of scope for alpha across, especially the mid and small cap space in Japan. So it's maybe an area that investors will refocus on, given that with loose monetary policy, of course, continuing maybe under a Kuroda second term, it's certainly a place that continues to be fairly favourable on a valuation standpoint for global asset managers.